charitable efficiency in churches, program expense ratios, overhead, and ethical standards compared to other nonprofit sectors. Introduction. Charitable organizations are entrusted with stewarding donor resources to maximize social impact. Among the most scrutinized metrics for evaluating nonprofit effectiveness is the program expense ratio, the proportion of total expenses spent directly on mission-related activities. Donors, regulators, and watchdog agencies often use this ratio as a proxy for efficiency, but its interpretation is nuanced, especially for churches. Unlike other nonprofit sectors such as cancer-focused organizations, food pantries, and soup kitchens, churches face unique challenges in balancing overhead, program delivery, and regulatory expectations. This report provides a comprehensive analysis of what churches are expected to do in terms of charitable efficiency, how their financial metrics compare to other nonprofit sectors, and the underlying reasons for observed differences. It explores the impact of mission structure, revenue models, and program definitions on efficiency metrics, and delves into the regulatory and ethical frameworks governing churches. Real-world examples of conflict of interest risks, best practices for maintaining efficiency and integrity, and donor considerations are discussed. The report concludes with a visual comparison chart of efficiency metrics across churches, cancer nonprofits, and food pantries and soup kitchens. Program expense ratio, definition and importance. The program expense ratio is a key performance indicator (KPI) for nonprofits, measuring the percentage of total expenses allocated to mission-related programs rather than administrative or fundraising costs. It is calculated as program expense ratio equals program expenses divided by total expenses times 100. This ratio is widely used by donors, grantors, and watchdog agencies, such as Charity Navigator and the Better Business Bureau Wise Giving Alliance, to assess how efficiently an organization uses its resources to advance its mission. A high program expense ratio is generally seen as a sign of efficiency and dedication to the cause, making the nonprofit more appealing for funding and public support. Industry benchmarks typically recommend that at least 65 to 75% of expenses be directed toward program services, with higher ratios, for example, 80 to 85% favored in sectors like health and human services. However, the ratio is not without criticism. It focuses solely on inputs, not outcomes, and can incentivize underinvestment in essential infrastructure or even misclassification of expenses. Despite these limitations, the program expense ratio remains a central metric for nonprofit evaluation, especially in the absence of universally accepted outcome-based measures. Typical program expense ratios across sectors. Churches. Churches, as religious nonprofits, often report lower program expense ratios than other charitable sectors. While precise benchmarks vary, studies and financial analyses indicate that personnel costs, salaries, and benefits typically account for 40 to 60% of church expenses. Facility and administrative costs, including utilities, insurance, and maintenance, can comprise an additional 20 to 30%. Program and outreach expenses, including missions, benevolence, and community services, often range from 20 to 40% of total expenditures, though this can be higher in churches with a strong outreach focus. Empirical data from church financial surveys and benchmarking reports show that the average church allocates 40 to 55% to personnel, 20 to 25% to facilities, 20 to 30% to ministry programs and outreach. Thus, the program expense ratio for churches often falls between 30% and 50%, though some churches with robust outreach or social service ministries may reach higher ratios. Cancer-focused nonprofits. Cancer-focused organizations, such as the American Cancer Society or St. Jude Children's Research Hospital, are typically held to higher program expense ratio standards. Charity Navigator and similar watchdogs expect at least 75 to 85% of expenses to be directed to program services in the health sector. Many leading cancer charities report program expense ratios of 75 to 85%, with some exceeding 85%. These organizations often have significant research, patient support, and advocacy programs, with administrative and fundraising costs kept below 20 to 25%. Food pantries and soup kitchens. Food pantries and soup kitchens, especially those operated as standalone nonprofits, tend to have exceptionally high program expense ratios. Typical program expense ratios range from 80% to 90%, with some reporting ratios above 90%. Administrative and fundraising costs are minimal, often under 10 to 15%, due to reliance on volunteers, donated goods, and in-kind support. For example, a sample food pantry financial statement might show program expenses, $196,900, 89.7%. Management and general, $15,000, 6.8%. Fundraising, $7,700, 3.5%. Total expenses, $219,600. Comparative analysis. Why churches tend to have higher overhead costs. Mission structure and program definitions. Churches differ fundamentally from other nonprofits in their mission structure and program definitions. Worship services, pastoral care, and spiritual formation are core activities, but may not be classified as programs in the same way as feeding the hungry or funding cancer research. Personnel costs are high because churches are service organizations relying on skilled staff such as pastors, musicians, and educators to deliver their core mission. Facilities are central to church life, serving as venues for worship, education, and community gatherings, leading to substantial ongoing costs. In contrast, food pantries and soup kitchens have narrowly defined programs, for example, food distribution, with most resources directly supporting service delivery. Cancer nonprofits may have broader missions, such as research, advocacy, and patient support, but their program definitions are closely tied to measurable outputs, revenue models, and their effect on efficiency metrics. Churches primarily rely on voluntary donations, tithes, and offerings from members, with limited grant or government funding. This revenue model requires investment in donor engagement, stewardship, and administrative infrastructure. Limits the ability to allocate costs to restricted grants or contracts, as is common in other sectors. Food pantries and soup kitchens often receive in-kind donations, such as food and supplies, and may benefit from government or foundation grants earmarked for direct service, boosting their program expense ratios. Cancer nonprofits typically have diversified revenue streams, including major gifts, grants, and fundraising events, allowing for more efficient allocation of administrative costs. Program definitions and functional expense allocation. The classification of expenses significantly impacts reported program expense ratios. Churches may allocate staff salaries and facility costs to program or administrative categories, depending on accounting practices and the extent to which these resources support mission activities. Watchdog agencies and the Internal Revenue Service provide guidance, but there is room for interpretation, especially for organizations with integrated program and administrative functions. Misclassification or conservative allocation can depress a church's program expense ratio, even when core activities are mission-driven. The overhead myth and its implications. The overhead myth, the belief that low overhead is always better, has been widely challenged in recent years. Experts argue that adequate investment in infrastructure, staff development, and technology is essential for long-term impact and sustainability. Overemphasis on overhead ratios can lead to underinvestment in critical capacities, ultimately harming program effectiveness. For churches, this means that higher overhead may reflect the true cost of delivering complex, community-based services, rather than inefficiency. Regulatory and ethical expectations for churches. IRS guidelines and filing requirements. Churches enjoy unique regulatory status under U.S. law. Automatic 501(c)(3) tax-exempt status. Churches are automatically recognized as tax-exempt if they meet basic requirements organized for religious purposes, no private inurement, no substantial political activity. Exemption from Form 990 filing. Unlike most nonprofits, churches are not required to file the annual IRS Form 990, which details financials, governance, and compensation. Exemption from state registration and reporting. Many states also exempt churches from charitable solicitation registration and reporting requirements. However, churches must still comply with Internal Revenue Service rules regarding private inurement, excess benefit transactions, and unrelated business income. Excess benefit transactions and intermediate sanctions. Excess benefit transactions occur when a church provides an economic benefit to a disqualified person, for example, a pastor, board member, or substantial donor, that exceeds the value of services or goods received in return. Key points include: Section 4958 of the Internal Revenue Code imposes excise taxes on disqualified persons 25% of the excess benefit, rising to 200% if not corrected, and on managers who knowingly participate 10%. Correction requires repayment of the excess benefit plus interest and may involve contract modification or property return. Written contemporaneous substantiation is required to treat benefits as compensation rather than excess benefit. Failure to comply can result in severe penalties, loss of tax-exempt status, and reputational damage. Transparency, conflict of interest, and governance policies. While not legally required to file Form 990, best practices for churches include adopting conflict of interest policies. Board members and staff must disclose potential conflicts and recuse themselves from related decisions. Documenting compensation and related party transactions. Compensation should be reasonable and based on comparability data. Related party contracts must be fair and approved by disinterested parties. Maintaining internal controls and financial transparency. Regular financial reporting, independent audits, and open communication with donors and congregants build trust and accountability. Ethical codes, for example, the National Association of Evangelicals Code of Ethics for Congregations, emphasize stewardship, accountability, and hospitality. Real-world examples of conflict of interest. Risks in church contracting. Conflict of interest arises when a person in a position of authority may benefit personally from a church transaction. Common scenarios include hiring or contracting with family members. Nepotism is prevalent in some churches, but must be managed with clear policies and recusal from decision-making. Board members providing paid services. For example, a board member offering architectural services for a church building project must disclose the relationship, recuse themselves from the vote, and ensure the contract is fair and competitive. Compensation decisions. Pastors or staff should not vote on their own salaries or those of close relatives. Case studies illustrate the risks. Embezzlement due to weak controls. A nonprofit switched to single-signature checks for convenience, leading to embezzlement by the executive director. Excess benefit transaction. A church paid its president a salary plus $35,000 vacation cruise, but failed to report the benefit as compensation. The IRS deemed it an excess benefit transaction, resulting in excise taxes and required repayment. Best practices include written policies, disclosure forms, recusal procedures, and regular board training. How excess benefit transactions are handled and corrected. When an excess benefit transaction is identified, the disqualified person must repay the excess benefit plus interest to the church. 2. Contract modification. Ongoing contracts may need to be revised to prevent future excess benefits. 3. Excise taxes. The IRS imposes a 25% tax on the disqualified person, rising to 200% if not corrected within the taxable period. Managers who knowingly participate may face a 10% tax. 4. Documentation. Proper records and board minutes are essential to demonstrate compliance and reasonable cause for any errors. Failure to correct can result in loss of tax-exempt status and further penalties. Best practices for churches to maintain efficiency and ethical standards. To balance efficiency, transparency, and ethical stewardship, churches should adopt the following best practices. Establish clear financial policies and internal controls. Segregate financial duties, for example, separate check signing, bookkeeping, and bank reconciliation. Conduct regular independent audits or financial reviews. Use accounting software and dashboards for real-time monitoring. 2. Adopt and enforce conflict of interest policies. Require annual disclosure of potential conflicts by board members and staff. Recuse conflicted individuals from related decisions and document actions in board minutes. 3. Set reasonable compensation and contracting practices. Base compensation on comparability data from similar organizations. Ensure related party contracts are fair, competitive, and approved by disinterested parties. 4. Promote financial transparency. Provide regular financial reports to the board and congregation. Make audited financial statements available to donors and the public when possible. 5. Align budgeting with mission and ministry goals. Use program budgeting to evaluate ministries based on effectiveness and funding needs. Regularly review and adjust budgets to reflect changing priorities and resources. 6. Foster a culture of stewardship and accountability. Teach biblical stewardship and generosity as core values. Express gratitude to donors and communicate the impact of their gifts. 7. Monitor and report. Key performance indicators. Track program expense ratio, administrative cost ratio, fundraising efficiency, and liquidity metrics. Use dashboards and visual tools to communicate performance to stakeholders. Donor considerations when evaluating churches versus other nonprofits. Donors evaluating churches face unique challenges. Limited public reporting. Churches are not required to file Form 990, making it harder to compare financials with other nonprofits. Here is the text to convert. Program definitions. Core church activities, worship, education may not be classified as programs in the traditional sense, affecting reported ratios. Transparency and trust. Donors should look for churches that voluntarily provide audited financial statements, clear impact reports, and open communication. Best practices for donors include requesting financial information, ask for annual reports, budgets, and audited statements. Assessing alignment with mission. Evaluate how resources are used to advance the church's stated mission and community impact. Considering alternative metrics. Look beyond program expense ratios to outcomes, donor retention, and community engagement. Supporting capacity building. Recognize that reasonable overhead is necessary for effective ministry and long-term sustainability. Measurement challenges and alternatives to program expense ratio. While the program expense ratio is a useful starting point, it has limitations. Focuses on inputs, not outcomes. High ratios do not guarantee effectiveness. Low ratios may reflect necessary investment in infrastructure. Incentivizes misclassification. Pressure to report high ratios can lead to questionable allocation of expenses. Ignores organizational context. Different missions, sizes, and stages of development require different resource allocations. Alternative and complementary metrics include cost per outcome. Measures the cost to achieve a specific result, for example, meals served, people housed. Donor retention rate indicates donor satisfaction and organizational stability. Liquidity and reserve ratios assess financial resilience and risk management. Impact and results scores evaluate actual changes in beneficiaries' lives, as used by Charity Navigator and GuideStar's Platinum program. A balanced approach considers both financial efficiency and mission impact. Churches have the lowest program expense ratios, primarily due to the high cost of personnel and facilities required for worship, education, and community life. These are essential to their mission but may not be classified as programs in financial reporting. Administrative and overhead costs are correspondingly higher. Cancer-focused nonprofits are expected to maintain high program expense ratios, reflecting direct investment in research, patient services, and advocacy. Administrative and fundraising costs are tightly controlled, and watchdog agencies scrutinize these ratios. Food pantries and soup kitchens operate with minimal overhead, leveraging volunteer labor and in-kind donations. Nearly all resources are directed to direct service, resulting in exceptionally high program expense ratios. While churches may appear less efficient by traditional metrics, this reflects the unique nature of their mission and operational model. Donors and evaluators should consider the full context, including the necessity of overhead for effective ministry and the limitations of input-based ratios. Conclusion. Charitable efficiency is a complex, multifaceted concept, especially for churches. While program expense ratios provide a useful benchmark, they must be interpreted in light of mission structure, revenue models, and program definitions. Churches tend to have higher overhead costs due to the centrality of personnel and facilities in their work, and their core activities may not fit neatly into standard program categories. Regulatory and ethical expectations for churches emphasize transparency, conflict of interest management, and compliance with Internal Revenue Service guidelines on excess benefit transactions. Real-world examples underscore the importance of robust policies, internal controls, and board oversight. Best practices for churches include adopting clear financial policies, conflict of interest procedures, reasonable compensation standards, and transparent reporting. Donors should look for churches that voluntarily provide financial information, align resources with mission, and demonstrate impact beyond input-based ratios. Measurement challenges persist, but a balanced approach combining financial efficiency, outcome metrics, and qualitative assessments offers the most accurate picture of organizational effectiveness. In summary, churches are expected to steward resources wisely, maintain ethical standards, and pursue transparency, even as their efficiency metrics differ from other nonprofit sectors. Understanding these differences enables donors, leaders, and regulators to support vibrant, impactful ministries while upholding the highest standards of accountability and trust. Comparison summary. Churches program expense ratio, 30 to 50%. Administrative overhead, 40 to 60%. Fundraising, 5 to 15%. Keynotes. High personnel and facility costs. Core activities may not be classified as programs. Cancer nonprofits program expense ratio, 75 to 85%. Administrative overhead, 10 to 15%. Fundraising, 5 to 10%. Keynotes, high standards for efficiency, strong emphasis on direct program investment. Food pantries, soup kitchens program expense ratio, 80 to 90%. Administrative overhead, 5 to 10%. Fundraising, less than 5%. Keynotes, minimal overhead, heavy reliance on volunteers. Church facilities use policies generally expect outside organizations to align with the church's mission, follow clear scheduling and approval procedures, and pay fees that cover custodial, utility, or service costs. Charges vary depending on whether the group is internal, community-based, or external, with priority given to church ministries. Key expectations for facility use. Mission alignment. Activities must be consistent with the church's beliefs and values. Uses that conflict with doctrine or faith principles are typically prohibited. Approval and scheduling. Requests must be submitted in advance, often through a formal application or request form. Church ministries receive first priority, followed by community service groups, and finally external organizations. Charges and fees. Church ministries, usually no charge for use. Community groups, for example, scouts, schools, nonprofits, may pay reduced or no facility fee, but are responsible for custodial, kitchen, nursery, or AV service costs link. External organizations, private events, businesses charged according to an established fee schedule. Fees often cover utilities, custodial services, and wear and tear. Liability and protection. Users are expected to protect the space from damage and may be held financially responsible for repairs if damage occurs. Church law and churches often require proof of insurance or liability waivers to limit exposure to injury claims. Cleanup and restoration. Groups must return the space to its original condition. Policies specify who is responsible for cleaning and setup. Typical fee structure, example. Group type facility fee, service fees, custodial AV, kitchen priority. Church ministries, none may apply first. Community service groups reduced, none often required second. External private organizations, full fee required third. Why these policies matter. Legal protection prevents discrimination claims and ensures consistent enforcement. National Center. Financial sustainability helps offset costs of maintenance and utilities. Community engagement allows churches to serve broader groups while maintaining boundaries. In short, church facility use policies balance openness to community engagement with protection of the church's mission, finances, and property. Internal ministries are prioritized and usually exempt from fees, while external organizations are charged according to a structured schedule.